This is Carrie Johnson with the Iowa Department of Management, and this is part 4 of a brief webinar series intended for county auditors and county auditor staff in regards to the Department of Management's local valuation system online and how to manage and understand tax increment financing and administration within the system. Part 1 was intended to give some background regarding TIF. Part 2 discussed setting up TIF taxing districts. Part 3 was in regards to TIF areas. And Part 4 is going to talk about TIF valuation and revenue. And it is intended to give a better understanding, explanation regarding TIF revenue calculations. And of course, the ultimate goal with TIF is to generate revenue that can be used again to repay debt that was incurred by the TIF authority. And the TIF base and increment taxing districts come into play there. We have a formula that's used to determine the available budget year TIF base and increment valuations. And utility property shouldn't be included because it's not on the assessment roll. Now, your software systems do these calculations for you, but to better understand how the revenue is calculated and to make sure that everything is coming out in the manner that you anticipate, we do suggest that you individually enter the valuation for each pair of TIF base and increment taxing districts into the formula that we suggest on the following page and add them all up. Add up all those individual formula-produced increment valuations to arrive at a maximum amount available for an area. So the TIF formula starts with the frozen base, 100% frozen base value. Of course, that's the value to which we compare growth. Then we look at the letter B, which is 100% budget year valuation. So in the budget year, what is the 100% value before rollback is applied? C is the amount of the budget year rollback. D is the taxable, so the remaining, whatever's taxable after rollback is applied in the budget year. And then E is the taxable budget year base value, to which all levy authorities will apply their tax rate. And F is the taxable budget year increment value, so the amount that's going to be used to generate that TIF tax revenue. The calculations are as follows. A minus C will equal E, and D minus E will equal F. So again, column A is 100% assessed frozen base value of the taxable property, and B is 100% assessed budget year valuation of the property. So the base year, and then what are we comparing to? And note, if A minus C produces a negative amount, you use 0 for column E. So let's walk through an example of calculating the TIF base and increment values using some real simple numbers, right? So commercial property. So originally it had $100,000 in valuation initially. So our frozen base value at the time that was set was $100,000. Say 2 or 3 years later, the budget year value is $300,000 in the budget year with a 90% rollback. So A, of course, is $100,000. That's our frozen base. B was what's the value, 100% value, a couple years later in the budget year, the year that we're calculating for. And our example, it's 300,000. C is how much rollback was there. So in this example, it's 30,000. So it's a 10% rollback amount because the rollback itself is 90%. So what's remaining? 270,000 as the taxable amount that's available for taxation after rollback is applied. So $270,000 is the taxable amount. $70,000 of that will go to the base because, again, A minus C equals E. And then the remainder will go to the increment. So that's our growth amount. Formula example number 2. In this example, we're going to talk about residential value. And the purpose here with residential value is just to show the impact of the rollback on the base amount of the increment calculation. So in our example here, we have residential value. Again, in this example, $100,000 in the frozen base year. So that was our value initially. Say a couple of years later, we're calculating this in this budget year. This residential area is now valued at $200,000. So $200,000 in the budget year, and our rollback amount is 50%. So in our example, $100,000 for the frozen base. Okay, at this point now, a couple years later maybe, it's valued at $200,000. How much is the rollback? So that's item C, and that's $100,000 because it's a 50% rollback. So 50% is rolled back and not taxable, leaving for D $100,000 as being actually taxable. A minus C will equal 0, so that's what's available to the frozen base, because the frozen base always ends up losing the rollback. That's where the rollback is applied, is to the base amount. And then F is $100,000 available for the increment, for the growth. So that was discussing how we arrive at the valuation number that is available to be taxed against and generate TIF revenue. So once we have determined our max levy, of course, we go through the process to adjust if they're not requesting the maximum amount, and that is something that your software system assists you with. So if they did have a certain amount available as the max levy, but they don't necessarily have the debt to support that large of a request, or they're not capturing all their TIF revenue, then you would apply that adjustment in your valuation system. But to calculate the actual dollars in revenue, the tax revenue, of course, always is taxable valuation divided by 1,000 times the tax rate, right? That's our general revenue calculation for property tax. In the TIF revenue calculation, it's the incremental value divided by 1,000 times the net consolidated taxing rate. So the net consolidated rate is basically the gross consolidated rate minus any of those protected levies that we discussed in the very first part of this webinar series. So minus any levy authority's debt service, minus the school's physical plant and equipment levy, and the school's instructional support levy. So the levies that are excluded, those folks still get to capture their rate applied to that incremental value. But for all the other levies, the TIF authority is going to capture the rate applied to the incremental value. So let's look at an example with numbers. So in this case, we have our different levy authorities listed here. We have their gross consolidated tax rate. We have them individually listed out. So say in this case, the county's levying $5, a school 14, ag extension, etc. And that gives us a total consolidated rate in this particular tax district of $32 to $73.30. So that's the total rate altogether. That's everyone's total rate added together. So to arrive at the rate that's applied for TIF revenue, first thing we want to take out is, of course, any debt service. So do any of these folks levy debt service? If so, then we would subtract out those rates, because those folks still get to garner the revenue generated on the incremental value of those debt service rates. And then for the school, in addition, they get to keep that $1 PEPL rate and $1 ISL rate applied to the incremental value. So our net consolidated rate is simply gross consolidated rate, subtracting out any of those protected levies. So subtracting out the school's debt, PEPL and ISL, subtracting out these folks also their debt service rates, and it equals a consolidated rate for TIF revenue, in this case of $26.97. So just keep in mind when TIF revenue is calculated that there are those particular debt service and school rates that need to be taken into account because they will not be used to generate TIF revenue. And again, some TIF authorities do request less than the maximum available TIF tax when they have enough, say, fund balance, when they, don't have the debt that's required to support requesting all the dollars. When this happens, unneeded TIF increment valuation is diverted to the base valuation within your local system at the time the January 1st valuations are certified to Department of Management. So before you upload values to the Department of Management system, in your local system, you're going to be pushing back value to from the increment to the base if it's not needed to service the debt requests of those TIF authorities. Again, for each year, for each TIF area, you need to reconcile the amount of certified TIF debt with the amount of TIF tax previously apportioned and to be paid in the current and upcoming budget year. In the end, you do need to make sure that there is no more TIF tax paid to a TIF authority than there is certified TIF debt. That is the responsibility of the county auditor. So it is a significant underscoring of the requirement of the auditor to understand the debt certifications of the TIF taxing authority and to make sure they're on top of what revenue is being received by that TIF taxing authority. And one thing to keep in mind in the online system, in order to run a report that will provide an estimated TIF revenue for the different TIF areas in your county, the current year TIF rates need to be populated. And the system should populate those rates for you. But if rates are not appearing for some reason, just click the populate rates at the bottom of the screen. And also, if you are adding any new TIF tax rate for any newly created increment district, you have to do that in the system as well. What the system does is it says, okay, these existing TIF districts, they are in the system in the current year. So we know what the rates are. We'll just go ahead and populate those for you. But for any new TIF taxing district that you're creating for the next budget year, the system's not going to have those in there. So you're going to have to manually enter a TIF rate for that. So in order to do that on the system, and you go over to the left-hand side and select TIF area revenue. And again, it's going to populate for you the increment tax districts that already have existence in the system and they already have rates. It'll list those. But in this case, we added a new TIF district. So there is one that's listed here as a new district, but it has 0 for the rate. So you're going to enter the estimated rate for the new TIF increment districts, and then you'll do a save. And that will allow for the TIF area revenue report to be generated. And this is a report that you're going to want to double check. Oftentimes your TIF authorities want to see these reports. It just lists by area each of the increment districts, what the increment valuation is that you have filed, what that estimated net rate is, and the estimated TIF revenue. And you would also want to double check the increment valuation report. It just lists, again, by TIF area, each of the increment districts, and the valuation as filed. If you have any questions about TIF revenue calculation or adding any of those rates to the system, please contact me. I can be reached by phone or email. Thank you.